Okay, starting to see our attendees filter in for today's discussion, so we'll go ahead and jump right in, time being minute after 2 Eastern, just after 11 a.m. Pacific. So I want to thank everybody for joining today's TMC Connect web broadcast titled COVID-19 Impact, Quantifying Future Mortgage Opportunities in Your Market, led by our partners at Emergent today. So Larry, if you would go ahead and skip to the next slide. And as part of today's discussion, I want our attendees to make sure to check out our TMC Connect and member event pages on the Mortgage Collaborative website. And you can view a schedule of upcoming TMC Connect broadcasts. I have a total of 9 sessions queued up for this week and encourage you to keep checking in as we're continuing to add new sessions based on the feedback that we're hearing from our members about really the most pressing topics within the industry. And then specific to today's discussion, in efforts to make it as insightful and interactive as possible, we've put together 3 polling questions from our hosts at Emergent that we're asking each attendee on the line today. Please take a couple seconds here and answer each of these 3 questions surrounding kind of the impact of COVID as you see it on your potential purchase business. And then later in the call, Bernard will be able to kind of review the responses and provide some statistics on those results to back to our attendees. So real quickly for today's discussion, just so you know, all lines have been muted for our attendees. That's just done to ensure, call quality for everybody and no feedback so that you can hear the discussion as clearly as possible. And as I mentioned, want these discussions to be as interactive as possible. So while lines have been muted and we will hold questions towards the tail end of today's discussion, I do encourage all attendees to feel free to submit your questions throughout the call. And I will go ahead and verbalize them with Bernard and Laird on your behalf towards the end of the discussion. Now, how do you submit those questions? Well, you can do that via 2 ways, either through the chat or Q&A box, both of which are accessible at the bottom menu of your Zoom screen. And so you know as well, today's call will be recorded and will be available for playback. Instructions to access a copy of the recording as well as copy of the presentation deck will be distributed to all attendees in a follow-up email you should receive tomorrow. So we'll go ahead and jump to the next slide. And so leading today's discussion is Laird Nasoli, who is CEO at Emergent, and also leading today's discussion is Bernard Nasoli, COO at Emergent. Hey, Bernard and Laird, how you both doing today?
Good, thank you, Tom.
Doing well, thanks.
Well, thank you both for taking the time out and extremely grateful for your expertise and taking the time to lead our discussion today. And just a reminder to our attendees, today's discussion is the second part of a 5-part series hosted by Bernard and Laird from Emergent surrounding COVID-19 and its wide range of impacts on housing and mortgage markets as we continue to learn more, not only about this pandemic, but as Emergent also continues to gather additional data, really drilling down to regional and metro levels to kind of understand the nuances out there as well as it relates to underserved markets, all of which we think will be impacted directly due to the impacts of COVID across the country, which does really make this series of content extremely insightful. I think for our members, when looking at, how do you adjust your growth strategies in different regions for 2020 and beyond. So last call to our attendees, just a reminder, please take a brief minute to go ahead and complete the 3 polling questions presented. Takes just a couple quick seconds and we'll report on those stats later on in today's discussion. So on that note, I want to turn it right over to Laird to go ahead and kick things off. Laird, the floor is yours.
All right, well, thank you, Tom. And thanks to all of you for taking time out of your day. I know that days are very busy these days, so we appreciate you taking time to listen to us share our insight. Before I get into a little bit of an overview for the day, I do want to touch on something Tom said, because I think it's really important to talk about. And that's that, with this unprecedented pandemic and the impact on markets, we're a data company and we're constantly looking at information, summarizing it, aggregating it, thinking about it. And the point of that is so that we can provide lenders and others in the housing industry with important information about, how is this going to impact their markets. But the reality is that there's so much data coming in, and it's coming in at such a rapid speed that our output and our forecasts are going to be changing often. And so one of the balancing acts that we have to have, and that I encourage you to think about, is that as data comes in, we want to keep thinking about it, but we always want to be elastic in how we're thinking about the data. Because at the end of the day, when you're thinking about what you're going to do, which is really the point of us sharing this information with you today, when you're thinking about what you're going to do, you have to think about it in the context of what strategies can I build that are going to be relevant and going to be successful in a variety of different scenarios. And that's the thing that I wanted to share, is just that as data come in, we're realizing that sometimes there are things that we're not going to know until we know them. So there's stuff that we know, and there's stuff we don't know. And it's that interplay that makes this so interesting, and at the same time, so complex. So for today, we're going to talk about how do we quantify opportunity in your markets. And Tom had mentioned that this is the second in a series. And so we're going to start today with just a quick update on our forecast. We talked about how we saw the national market going last time. And so we're going to revisit that. We're going to, and I'll give a little bit of background, not as much as last time, about our model and why we see the results we see. Next, we're going to talk a little bit about, what are some of the critical data and the trends that we need to watch. I guess those are the pieces of information that, our ears are open to hear, and I'm hoping that a lot of you are also keeping in mind. And then we're going to really get into what we're talking about today, which is, why does where matter? Why is it not enough to look at our national forecast for COVID-19 or for purchase originations after COVID-19? Why isn't it good enough to just say, okay, here's what's going to happen? Why do we need to drill down into individual markets? And so I'm going to talk about that. And then finally, Bernard's going to take over, and he's going to do a little bit of an action-oriented example of how you can really dig into a market to utilize data in that elastic way that I was talking about. So that's our plan for this next, I think, half hour, 45 minutes. So I'll start with our market forecast. Okay, can you guys see? All right. So we're going to start with refi, because in some ways it's the more positive piece. And as you all know, because I'm sure you're dealing with full pipelines and busy days, we're looking at a record-breaking year of originations in refi. Our midpoint of our forecast, because typically for refinance, we forecast a range. Our midpoint, right, is about the 1.575 trillion point. Our most aggressive, I guess you say positive forecast for refi, has it actually going to about 1.7 trillion. Just to reiterate, that's a big year. But it's an important thing to know, because on the other hand, as you can see that I just pulled in and you saw that little arrow drop down, we're looking at a very, very big drop in what we would call a shrinking purchase origination market. So our initial forecast, last year's HMDA data came in at about 1.2 billion in purchase. And we're looking at that dropping roughly 37% to around 752 billion in purchase dollars. That's a significant drop. That's one of the things we wanted to find out through the polling was, where are you thinking about this? 37% drop nationally. How is that intuitively feel when you're looking at things happening in your individual markets? So what does that mean though for the next 2 years? Because really, as we're looking at 2020, that's what we're going to talk about immediately today. But we need to already be thinking about what's 2021 going to look like? What is this recovery that we keep hearing about? You know, whether it's a V, a U, a W, a swoosh, you know, what is that going to mean, again, for your markets and the industry as a whole? What's circled right now, obviously, is this huge drop in purchase originations, counteracted by a huge increase in refinance. So together, what that really puts us at is total originations in units up 10% from 2019, so that's good news, and in dollars, up about 3%. So this is important. And I think one thing that we always talk about at Emergent is the importance of focusing on your purchase business. And I agree with that, and I always will. But at the same time, in this particular market, with this impending, you know, shrinking market, it does make sense for you to be putting a lot of time and energy into maximizing your originations, you know, from the refi perspective, and, you know, really finding wide margins and increasing your profitability now as we transition out of this refi strong market into a more difficult purchase one. So before I get into the why of our forecast, I just want to touch very briefly on our approach. So there's a lot of different ways you can look at, you know, forecasts of housing activity or lending. Well, we're very much a demand-focused approach. And so what that means is what we are really looking at is really the home buyer pool. And what that means is we're looking at the total number of households that are ready, willing, and able to buy a home within a particular time period. Now, what's important about that is those three pieces: ready, willing, and able. They have different data points associated with each one of them. The first one that I'm going to talk about is really the able. Able really comes down to the point of, you know, we're talking about what does credit look like, what's going to happen with unemployment, all of those various pieces that impact whether or not a household would be able to originate a loan within the next year. The other side of that, though, and it's much more difficult to quantify, is the idea of ready and willing. And that's where we're going to talk later about uncertainty that comes along with the intersection of, and this little bubble over here kind of shows that, the intersection of uncertainty between health, economics, the industry, and personal uncertainty. It puts people in a place where the question is, are we able to, or, you know, not if we are, even if we're able to, are we ready in this environment? Do we want to look for a home, buy a home, and originate a mortgage? So those are a lot of big questions that will continue to shape that, you know, $752 billion forecast that we're looking at nationally. So with that in mind, for the sort of the demand focus, I just pulled up what we consider our home buyer pool slide. And Bernard, I don't know if you want to take over and just talk about this a little bit first. I'll let you go ahead.
Yeah, just a refresher. You know, this was part of the graphic we showed in our last webinar. But the idea, as Laird said, is we actually started with 123.5 million households, but not all of them are ready, willing, and able to purchase homes this year. And as Laird mentioned, some of the factors that take households out of the home buyer pool are listed in the table. So first and foremost is unemployment with you know, close to, I think it was 33 million as of last week of people filing for unemployment. So that's a massive impact on, you know, especially for underwriters as they're looking for ways to approve folks. But also, you know, 11.3 million recently purchased a home, in the sense that they purchased one in 19, 18, and then part of 17 potentially. Last year's people who refinanced last year are not going to be buying homes. And then some of the other problems facing certain borrowers are some of their credit issues, whether they have defaults or delinquencies, if they've recently foreclosed, and if they have any modifications and workouts or households underwater. So again, the idea is that we've reduced the homebuyer pool from 123.5 million to 73.1 million.
All right. So so a little bit more about the, you know, what have we seen since the last webinar. Well, we were hoping that we were going to see claims, not really slow down. We knew that there would be continued claims coming in. But, we finally were able to get a full month, or we got our the official April report for unemployment, which is about 14.7%. And this chart here shows that in the last 8 weeks, we've seen a record 36.5 million claims. You got to keep in mind when you're looking at, this claim information. First of all, it's a leading indicator, but it does not include workers who did not file for unemployment insurance. So either those that don't qualify or those that just simply didn't do it. And so in some ways, even though these are only claims and they're not indicating what will be lasting unemployment, they also aren't covering all the potential households impacted by this. Obviously we're looking at a lot of different sources, and I saw some statistics that said 20 states have seen greater than 20% of their labor force file for unemployment since March 7, 20%. And those are the highest three, greater than 30%, are Kentucky, Georgia, and Hawaii. There's only 2 states that have less than 10% of their whole workforce filing, and that's Utah and South Dakota. So this isn't a very positive sign at this point. We put that into, a kind of perspective with the recession in the Great Recession, the total job losses of 8.8 million. Well, we've also, the 22.7 million in jobs created since then, we've just wiped that out. And I think what is becoming more and more concerning as we look at this data is that this is showing widespread job uncertainty. Yes, it's true that this unemployment is skewed to particular industries, and we're going to get into that in a little bit. But it's not just to those industries, and we're not just looking at households making under 40,000. We're seeing these unemployment claims happening for lots of types of workers, and we're also hearing that that these claims are showing that more jobs are vanishing. At the end of the day, what this means, most of the projections say that we're looking at double-digit unemployment is likely through the end of 2020. Now, what that double-digit looks like ranges from 14% like we saw in April, up to as high as 23, 24%. So a lot of variation still with what's to come, but the bottom line is that this is going to severely impact that homebuyer pool. So the next piece, of uncertainty that we're talking about is the fact that, and here again, we don't have all the answers yet. We're all looking to see what's going to happen, but many states are opening up for business. And along with that, and I think the reason behind that decision to do so comes with the hope that this is going to have a significant positive impact on the economy. We're hoping that retail sales pick up. We're hoping that some of these unemployment claims truly were furloughs that are going to end and people are going to go back to work. I was looking on Redfin, and they had some really interesting information about what's happening with real estate. They actually contrasted 4 different markets. But what I liked that they said that I wanted to share was they said it was Seattle, Detroit, I think Riverside, and one other market. They said that home listings tanked and then trickled back. They saw home sales sink and then rebound. So that's what happened, with the virus kind of hitting really hard. I know specifically with Seattle and Detroit, and then watching as, the concern and sort of the flattening of that curve, they're seeing things start to get better. We've also seen an increase in the mortgage purchase application rate, a little bit week over week. Problem though, and the question remains, from that side, if businesses are open, will people come back in? What is this going to do to how the people are looking at spending, whether that's, on a new pair of shoes, or it's, going out to the, and looking for, being in the market again to buy a home. So that's one of the big questions. And the other big guiding piece, and this is, that effectively that bottom bullet in this page, will COVID-19 outbreaks come back with a vengeance? Almost all of the disease models out there say yes. And so when you see this map here, which is state by state to the left, you can really see that there are a number of states that opened, in the opinion of this, this model, far too early. And so that's something we're going to have to wait and see. Was it from a disease perspective, a mistake to do so? The other hand, and the other fear is that even though there was reopening, and even though, let's say, we don't have a huge risk of occurring outbreaks, we still are not seeing the change, yet in how does this change unemployment, and how does this change the job loss environment. I think that there was one of the national newspapers had the headline, "Rolling shock as job losses mount, even with reopening." That wasn't what was intended. That wasn't what was hoped. Because one of the issues with that is that, yes, people are going back to work, but these workers are going back with reduced hours, therefore smaller paychecks, and a lot of them with substantial risk of infection. So, you look at all of that and you're like, okay, how is this going to play out? What's the balance of positive and negative going to be to these choices to reopen? Two other quick things to mention. I don't know if you have children, we do. Schools are out for the summer, and a lot of summer programs are canceled. So there is the reality that some parents can't return to work because they don't have childcare options. And in many states, because they're not returning to work, even though their job is opened up, they're no longer going to be eligible for unemployment benefits, which not only means that that's going to be an unemployment rate, it also means that they're not going to have the support to help continue through the next 3 to 4 months. So again, I think there's a lot of ups and downs and unknowns as we look at this. So what pieces of data are we watching? I think I kind of hit on all of those, but that at the top of this, upside down funnel, we're really looking at the disease activity. So much depends on what happens, because, if there are these pockets of resurgence, unemployment is going to trend, and rather than being this, kind of return to employment, we're going to see these dips. Even if it's a whole bunch of V's or a whole bunch of U's, what that ends up equaling out is a really longer recovery. So disease is going to impact unemployment. Unemployment's going to impact, what's happening with, forbearance, and, how many loans in forbearance are going to turn delinquent, and, what is foreclosure risk like as households realize that they are not going to be in a place to continue to pay on a mortgage after their job is lost for good. So obviously that's going to impact some credit and lending policies. And at the end of the day, and I think this is the piece that, again, we were getting at with the poll we took at the beginning, is all of these different factors kind of come together and can be seen at the local real estate market condition level. Now, I wish I could say that, it's going to be true that if real estate is considered a essential activity and there are homes, on the market and there are buyers, that this means that things are going to continue as normal. That's probably not going to happen. The local real estate conditions in terms of, the supply and regulation, are really not going to be what's influencing that forecast. It's really going to point back to that, those other questions, which is, how do people feel about borrowing? And more importantly, are they able to? What has happened to them economically? So that's, what we're seeing. Again, this is the pieces of data that we're going to watch. With that being said, we wanted to talk about where and how this matters. And again, going back to that initial discussion point, which is all this data keeps coming in, and it's going to be, there's not a forecast for lending activity, but there is a whole bunch of forecasts, with that, emphasis on the plural being, this is going to impact different markets in different ways. And that's the reality of it. And I'm going to talk a little bit here about why, but the first thing is that there's a difference in disease impact. Some markets have been hit harder than others. There are a lot of explanations for why that is. Just a couple of, for example, when you're looking at case rates per 100,000, Detroit has a case rate per 100,000 of about 796 cases per 100,000 people. Contrast that with Riverside, California, which has a disease rate of about 196.3 cases per 100,000. Columbus is right there in the middle at about 350. So that's the case rate. So what you're basically seeing is that the disease impacts and moves through different markets more quickly than others. And again, I think some of that has to do with, density of population in the rural versus suburban versus urban communities and how easy it is to practice social distancing. The next piece of this is just disparities in disease severity. I could look at those same pieces of information and tell you that in Detroit, we're looking at 91.5 deaths per 100,000 people. In Riverside, it's only 8.5. So there are differences in how not only people are becoming infected, but how the disease is impacting them. And I know you've heard, and we're going to spend more time on this in the next webinar, but you've heard that there are race and ethnic differences. What physicians and the research community is trying to figure out, is it inherently due to race and ethnicity, or is this really an outcome of socioeconomic differences and access to quality healthcare that's impacted a lifetime? So those are different pieces. From an economic perspective, we see a similar type of disparity. Unemployment, the biggest challenge, and I think what we're looking at, and we're waiting to see MSA level unemployment numbers, which don't come out until I think June, mid-June, early June, is that the metropolitan areas that are the most impacted by unemployment are those that are going to have what we call high risk industries for unemployment. I'm sure you've all heard of what those industries might be, but it ranges everything from obviously travel, housing, food. Travel, hospitality, food services, manufacturing, construction, airlines. Anything that either is in retail that it has been directly impacted by closure, or jobs that can't be done from home. And I think immediately, we're in Des Moines, Iowa, and there's we didn't have a high rate of infection until some of the people who work in our meatpacking plants did. Well, that's a pretty high risk industry. It has to keep happening it's considered essential, yet all these employees are at high risk, and not only for infection, but also with the high exposure. It's a lot, the death rate is a lot higher. So, market by market, you're going to see differences like that. Another thing that's different for how this is impacting certain metro markets, some of them see an immediate impact, negative impact, and some are going to see this over the long term. And again, that has a lot to do with the types of industries that can constitute and make up that particular market. And finally, again, I mentioned it before, even though it's probably the smallest piece, what does the where matter in terms of how COVID impacts housing really looks, we're looking at things like the disparities in home value to income, or what that ratio looks like, because when you start talking about issues with, credit and wage and income, that's so tied to what does it actually cost from a wage, from an income perspective to get a home, so that the markets with the greatest, the highest ratio are probably the ones that are going to struggle more in the long term with economic downturn. So that's what we're looking at from a where perspective. So again, today we wanted to talk about not just what those data look like. I could go state by state, I could go region by region, I could go metropolitan area by metropolitan area, and we'd be here for hours looking into each one of them, and there's a different conclusion to draw. But at the end of the day, what does this mean for lenders? What it means is that you have a challenging purchase market ahead when the refi slow down. There's going to be a tough battle for market share, and that market share isn't going to be just, enterprise level. This is going to be enterprise level share issues and sales level share issues. And that piece is what Bernard's going to talk a little bit about when I'm done, kind of giving you the big picture here. With that kind of shrinking market or weakening market, strategic and tactical efficiency are going to be more critical than ever. And then, of course, again, the kind of the crux of today is different markets are going to have different opportunities and threats. And what that means is that you will have unique opportunities to innovate, to improve, to redefine, and navigate the situations, again, market by market, as this information comes in. So we walk away with the question of, how do you move forward? And this is that piece that I started with, which is, these are uncertain times. What are you going to do? How can you, without all the information that you need, and not, static information, with, flexible information coming in, how can you make decisions about what's going to happen 3, 6, 9, 12 months out that will be relevant, even if things get better, things get worse, things get better, these things get worse. So, what can you do? Well, we obviously have an opinion about this, and I think whether it's using the data that we have, using other data, other tools, the important thing is you can't wait to return to normal. You can't wait for certainty in data. It's not going to be there in a timeline that helps you move forward. Now, that's not saying don't think about data, because that, we can't rely on what happened last year. We can't rely on lessons from 5 years ago. We have to be looking at this as a new thing. So you can't wait for certainty, but you also can't wait to get started with strategy planning. So what you can do is you can start quantifying your future opportunities, and what that really means is your demand. What is home buyer demand going to look like in your markets? You have to look by market, and you have to look by borrower segment. And those things, when you add up, those are the different pieces that you add up to. What is my market opportunity for my enterprise? Because your enterprise isn't just one market, most likely. It's a compilation of multiple. And you're going to have to look at those in a granular way so that you can be targeted, and you can find what you've missed, find new ones, and then build that efficiency through strategies that are going to work no matter what those scenarios look like. So that's really the path forward. And just to kind of hammer that point home, and I'm not going to go through all the different markets in this. It's 15 different markets that I chose randomly. Well, somewhat randomly. They're not the top largest 15, but they're 15, and I hope that you guys can review this PowerPoint later and really dig into this data. And I hope there are markets that are interesting. There's at least one market of interest to one of you. But what I wanted to use this chart for was to just highlight differences in this opportunity. And as we look at differences between, say, Washington, D.C., where it's a relatively low risk from an industry perspective, we're still seeing the purchase dollar drop from a $40.2 billion market to 31.5, or I'm sorry, 40.1 to 27.1. That's a big drop. We're also getting looking at, contrast that with Riverside, where over 50% of the industry is at, or of the employment pool is at risk for, is at high risk for unemployment. You need to know the numbers in bold here, these 2020 dollar and loan counts. And you need to know those because those should be driving your decisions about resources, whether that's salespeople, operational people, branch location. That needs to, you have to be sizing your market if you're going to size your resources, size and plan your expenses, and therefore understand your profitability. So there are so many different pieces that are going to be dependent, your pieces to your success that are going to be dependent on what happens to the demand in your markets. Bernard's going to dig down in a minute and look at Riverside, and I'll just frame it for a second. Riverside was one of the markets that we see a lot of risk from an employment perspective, but it's interesting because in other ways, it has some mitigating factors that allow it to be, shall we say, a little bit, more positive than it would indicate with this, at-risk industry at 52%. But what I wanted to show here is that we're looking at a market that's going from, in purchase dollars, 18.7 billion to 12.1 billion. And I will say our forecast is going to be changing, and more than likely it's going to be changing down. But still, this is a big enough drop that I think it makes a strong case for why we need to start looking and really, really become targeted at a market level. So I'm going to stop with my piece. Bernard, I don't know if you want to jump into Market Smart and show Riverside, or if you want to talk about any results from the poll. It's really up to you.
I was going to jump in first to Riverside. So I'm going to share my screen. All right, can you see the map? Larry, can you see the map?
Yeah, I can see the map.
All right, great. All right, so what we picked Riverside, and the backdrop is a lender in Riverside is saying, hey, you guys are saying a 35% drop in my purchase originations from last year to this year. You know, what can I do in this reduced purchase, basically, you know, economy? So what I'm showing right now is the San Bernardino MSA by county, so 2 counties, San Bernardino and Riverside. And San Bernardino is 4.1 billion for this year, Riverside 6.2 billion. And so if I'm a lender here, I want to see where my branches are. And I say I have, you know, a lot of branches in LA, but I have a few in Riverside itself, 6 it looks like. And so the idea is to say, all right, great. Well, I'm well positioned. I have branches in both counties, so that's great. But these counties are huge. I mean, the opportunity, even though it's dropped, it's still huge. So we have to dig deeper. We have to zoom in. We can't just stay at the county level, because we would have to assume that the opportunity is uniformly distributed, which clearly it's not. So we have to go to the census tract level to find pockets of opportunity. And so I'm going to zoom in. I'm going to actually apply my census tract view. So from the county view to now the census tract view, we see these different little pockets again with the heat map from blue indicating less opportunity to red indicating more opportunity, where, hey, we might be well positioned, and I'm going to zoom in the market, since we have some branches already located here, for example. So this is total opportunity that we're looking at for this year. So what happens if we add our 2020 year-to-date originations? So every dot now represents an origination, and I can see, okay, I'm doing some loans around the branch, but I'm potentially, you know, this branch as well, but I'm potentially leaving money on the table because I'm not capturing all of this opportunity in these census tracts. So, for example, if I'm looking at this red census tract, we're saying, oh, great, you know, we have potentially one loan that we've originated here. So the idea is that it's in close proximity to your branch, but now, you know, either the LO sitting in the branch is spending his or her time, you know, elsewhere where the opportunity isn't as great, and the idea is to either focus that loan officer on this area, or to potentially at least not, if you're not hiring, but at least not downsize somebody, to say, hey, we still have plenty of opportunity in our own backyard. But there are the gaps, which again are identified when we overlay originations on top of our forecast map. So what does this market look like if I take off the census tract view of total purchase, and instead I'm focusing on jumbo? So now I can see that the census tracts that were red for total are also red for jumbo, and so if this is part of my lending strategy, as this particular lender is, then I'm still situated well, in the sense that this branch is close to the opportunity in these census tracts. Okay, but let's contrast that. So let's go to the opposite end, and instead of jumbo, let's look at FHA. And now FHA tells a different tale, where potentially, you know, this branch over here is better positioned to capture that opportunity, being in closer proximity. But regardless, whether you're looking at jumbo or you're looking at FHA, there are gaps in coverage that you can immediately see on these maps when you can overlay your originations and see, hey, we're leaving money on the table. We're not taking full advantage of the opportunity being presented. So what can we do? you know, we can tell our loan officers, all right, well, if we're going after FHA, here's where you want to be. And the loan officer might either, you know, take the impetus and go for it, go explore those opportunities, or they might kind of resist and say, well, great, I know where to go, but, you know, what do you want me to do next exactly? I mean, how can I get more business? I know where it is, but how do I drive more business? And so that's where we've created a tool that kind of goes from the strategic, so this overview of the market at the census tract level with the forecast, to down to the tactical, where we now overlay a live MLS feed over the top of the map. And so the idea is that every diamond now represents a live listing, and I can pull it up and see, okay, the listing that I pulled up is at 18024 Ribwart Road, and the list price is $529,000. And by the way, the listing agent is Jason. And if you wanted to start contacting Jason, you would just have to click on his email, which is active. So that would pull up your, you know, whether you're looking at Outlook or Gmail, or even Hotmail for some of us who don't want to admit. Then you can email that person directly. But also the best part about this listings layer is when you go to view the data. And so here, well, we see that we have a bunch of filters already on. So I just want to see listings that have a list price under, you know, 1.4 million, that are active and residential and have been on the market for fewer than 35 days. So I could change any of these filters. But the point is that from here, I have a list of all 1,600 listings that were on the map, and I can easily export them to Excel if I wanted. But the best part is when I look at this information, these 1,600 listings by agent. And so now I go to my agent tab and I see all of the agents' names and all of their contact information, provided there are some, and then I can sort them by active listings to be able to really drill home to these loan officers that, hey, don't just talk to an agent that is doing, you know, one listing a month or doing this on the side. Really go after and start building relationships with the agents that are the most active. And so over Zoom, this takes a little bit of time, but once it sorts, we should have an entire list that says, actually, this is your list of top listing agents in that market, and you know, pick the top 5, pick number 10, whatever works for your strategy, and start building that relationship to make sure that, you know, next time they list, you make sure you're getting more share of business from those agents. And so really it starts getting into this longer term strategy of being able to know who is doing all of the listings in that area that is corresponding to your specific lending strategy as the lender. And so I'm gonna get out of this for a second.
Bernard, can I step in for a sec?
Yeah.
Add something. So, you know, one thing, this is, you know, again, Bernard's talking about the importance of this, you know, with top agents. But one thing we've been seeing lately, and, you know, this tool is just really meant to show you how, you know, at a micro level, you can be strategic. But what we found and what we think about, you know, you can do the same thing and you can be looking at delistings and things like that, but it gives you a local sense of what's happening in the market, and it gives you a strategy for how you can start, again, building your business, loan officer at a, you know, one at a time, in a way that says we're coming with added value, you know, because what I think what the data is showing us is that it's going to be a partnership between lots of, you know, realtors, LOs, community groups that are going to be able to work together to help the homeowner or potential homeowners, you know, kind of rise above some of the challenges of COVID. And so that's what we were kind of getting at, that, you know, this might be Riverside and this might be this one piece, but you do this market by market and it adds up and aggregates. Sorry, Bernard, had to jump in.
No, thank you. So yeah, so I'm It is coming through, so I'm gonna wait for it a little bit. But in the meantime, again, it's going. I just want to hit the point of for any market, you know, whether you use this tool or your own, the important point is to be able to identify or quantify the opportunity in your specific market, and then to go after that opportunity in conjunction with your specific lending strategy. So whether it means, you know, you have specific jumbo products or conventional products or first-time homebuyer products, that's how you go after the market. Okay, so here it listed, it said, so for example, if we look at, you know, this top agent, Michael, he has 300 total listings, of which 82 are active listings within the market. So these are the folks to start building those relationships with. And again, based on MLS, they'll provide the preferred phone, the agent email, and so forth. So I also wanted to show just briefly this competitor field. So again, this is Riverside at the MSA level, or excuse me, at the county level, where we have the two counties, Riverside and San Bernardino. And this shows the top lenders based on 2019 HMDA. So this is actually hot off the press and loaded into the system, where we can see, you know, United Shore was #1 in both counties, followed by Quicken, followed by Loan Depot. But then as we get to, you know, the rest of the lenders, we can see who is in which spot and with what share. And obviously I did this for the top 10 for the demo, but we can do this for all lenders in that market. So I'm just gonna go back just to the map again to understand, to reiterate one last time, that we can figure out the best strategy for any particular market when we overlay, you know, the specific, whether it's FHA or VA or FSA or by borrower group. We can look at Asian, African American, Hispanic, and say, okay, this is the market. Here are your branches. Here are your originations. Where are the gaps in coverage? And then how do we go after those gaps? How do we fill those gaps by going from strategic to tactical by adding the listings on top of the map? So I know
what I've got for you, Bernard.
Yes, go ahead.
Real quick, just as you're going through it, because I love what you both have done to kind of paint that picture on how you segment the different filters of data versus the listing and all these different MSAs to really drill down to the target audience that you're looking to, you know, to leverage to capture and grow your market share. From that filtering of current listings, can you also drill that down then by, say, common characteristics for, you know, what might qualify for, say, like FHA? And I think you kind of evidence based on like the list price, you know, more of like a jumbo filter to that listing, but just thinking about like different loan types as well, depending on, you know, what a given lender's strategy might be, yeah, especially too if they're looking at drilling down to, you know, I guess a detailed list of agents who to target that may have, you know, potential characteristics for a strong swath of first-time home buyers as well.
Yeah, absolutely. I'll let Laird speak to that, but also say that I'm showing the listing, the specific filters that I added. So here we're saying by list price, you know, 0 to 14 million, but obviously we could scale that more geared towards, for example, first-time home buyer. So, you know, 0 to maybe 500,000 or 350,000. We can also figure out, just like you said, based on the specific agent, what the specific agent closing price is. So, you know, based on their total active listings or their sold listings, what's their average close price, and you can go after specific agents that way to say, oh yeah, these are more first-time homebuyer agents, and attack it that way. Laird, did you want to add to that?
Yeah, I do. I just want to say that, you know, one of the things, you know, we have I'm going to use a client example, a client who has a really good USDA product, and we do have an overlay We can add different overlays for different accounts. On the eligibility and the ineligibility places to be able to do USDA lending. And what it allows that, the way that the LOs and the branch managers are using this is to basically say, okay, here's this difficult environment, going to different partners, whether it be realtors or community groups, and saying, here's information that we have that's strategic, that's constantly changing, but that we can work together to be more, to be better at our offerings. And so that could be, like you said, Tom, we could look at FSA type areas. We could look at places where there's a lot of VA, but it also could really work at things like where there are down payment assistance programs and stuff like that. I just glanced at the time, and I know we're going over, Tom, so I can we can be done.
Yeah, I appreciate that. A lot of great insightful information, and I really wanted to make sure that we wrap with kind of highlighting some of the the different filtering and segments that you can really break down this data metric through your Diversify offering to. It gives lenders a ton of tools to truly segment really extensive drill downs of the markets that they want to attack to grow their market share. So appreciate you guys going through that detail, and definitely want to thank you again for going through all these insightful overviews for today's call. Is really looking at how this evolving COVID situation is going to affect purchase markets, and sharing some tools with how our lenders can position themselves to stay out in front of the game as best possible. So I want to thank you both, and I want to remind our attendees to stay tuned, as we'll have part 3 of Emergent series coming in June with some updated dates for that agenda coming very soon.
Thank you, everyone.
Thanks, everyone.
Have a great afternoon, everyone.